Serenis è il partner di The Bull per il tuo benessere mentale e fisico, un centro medico autorizzato che tramite la sua piattaforma digitale offre percorsi di psicoterapia, nutrizione e coaching online con oltre 1600 professionisti in tutta Italia con in media 13 anni di esperienza. E lo fa con una missione: rendere accessibile il benessere mentale e fisico affrontando gli ostacoli economici, tecnologici, sociali e culturali che allontanano le persone dal prendersi cura di se stessi. Vuoi iniziare un percorso su Serenis per prenderti cura del tuo benessere mentale a un prezzo convenzionato cliccando sul link che trovi nella descrizione di questo episodio.
Average is not invited. Not if you're holding your company off-site in Las Vegas. We aren't on friendly terms with the bare minimum, and unenthusiastic is uninvited. Las Vegas's creative energy and world-class hospitality want to bring your company off-site to crazy new heights. That's why fear-based leadership is afraid of Vegas. And boring? Won't be there, but it will be watching the meeting recordings later. Plan for the extraordinary at vegasmeansbusiness.com.
Welcome back to The Bull, your personal finance podcast. No small talk today. Dear friends of this podcast, get ready to listen to one of my absolute go-to experts when it comes to understanding pretty much anything related to portfolios, markets, stocks, factors, and in general every relevant topic in personal finance. Defining Larry Swedroe in just a few words is truly difficult. Successful millionaire investor, researcher, asset manager, teacher, educator. Basically, Larry Swedroe is like an extraordinary human Wikipedia on investment topics. Larry has written over 18 books on various aspects of evidence-based investing, that is, investing based on facts, number, data, and research, never mere opinions. Through his books, articles, and the wealth of content available online, Larry has distilled the insights of hundreds of academic papers with remarkable clarity, helping millions of people worldwide become better investors. His latest book is titled Enrich Your Future, a phenomenal guide to understanding the fundamental principles that should guide every investment decision, with a precious foreword written by a titan of Wall Street, Cliff Asness. To my Italian audience, remember that the same episode is available in a translated version too on the same podcast platform you're using. Without further ado, let's dive into my conversation on evidence-based investing principles with the great Larry Swedroe. Enjoy the episode. Dear Larry, welcome to my podcast, The Bull.
My pleasure. Glad to be here, Ricardo.
It's great to have you here, Larry. It's amazing you will provide us with your immense financial wisdom. The first question is, you have written 18 books so far. You deliver tons of content on a steady basis. Why have you decided to spend so much time teaching people how to invest?
Yeah, I decided to do that as my way of giving back. I grew up in a lower middle class family, sleeping in a kitchen for the first few years of my life. Got a great education in America, a great opportunity, and then went on to make a career decision. I worked in an investment bank. I took a pay cut to try to turn around a company. And 10 years later, we sold it for over $1 billion. And I was able to, I had a very small slice of that billion, but it's enough to retire on. I was going to go and teach. I had guest lectured at Stanford, some other places. I really liked teaching. And then friends of mine told me that they had started an investment management, a wealth management firm. It turned out that they were really good financial planners, but knew nothing really about investing. And I had spent my entire career at that point helping to manage risk for some of the largest financial institutions in the world. I advised some of the largest companies in the world on managing all kinds of financial risk. So I thought this would be a great way to help people learn how to invest the proper way based on investing. And then when I joined the company, I said, we need to have some marketing material. They had nothing to explain what we were doing, which was based on what we like to call the science of investing, not our own opinions about what were the best stocks to buy or where the market would go, but based upon peer-reviewed academic evidence. And there really wasn't anything out there at the time in 96 when I joined. The only good book I thought on investing was written by Malkiel, called A Random Walk Down Wall Street, which is a great book.
Totally great book.
It was very thick and didn't tell you what to do with the information. He said it's very hard to beat the market. You shouldn't be an active investor. You shouldn't try to pick stocks at time the market. But he never told you what to do with that information. So I said, all right, let me see if I could put together a book to do that. And that's how I wrote the first book. And then 17 more followed.
The first one was the only guide to a winning investment strategy you'll ever need. Am I right?
Correct. But it turned out it wasn't the only one you ever needed. So,
in your articles, you always talk about evidence-based investing and treat finance as if it were a positive science. You pick cutting-edge research from academia and insightful professionals and break them down to make them actionable for the retail investor. Is that correct?
Yeah. The problem that most people have, and this is why I decided to write my book and the content is, in at least the United States, and my guess is, from what I know, it's true all around the world, unless you get an MBA in finance specifically, you've probably never taken a single course in capital markets theory. How do you know about the world of investing? Most people get their, quote, knowledge about investing from some stockbroker, insurance person, or active manager who's trying to sell you something, not give you advice that's necessarily in your interest. So, for example, in my books, I explain my daughter is a very bright girl. She finished in the top 10 in her high school class. She knew more about amoebas than she would ever know about investing. No one taught her anything, right? And so I decided that would be my job, my way of giving something back, would be to teach people what the academic literature said. And so the example that I would use, Ricardo, is this. Say you're not feeling well, got a cold, a headache, maybe a little achy, fever. This is going on for a week or so. Finally decide, better go to the doctor. Go visit the doctor, puts you through a battery of tests, calls you in and says, Ricardo, based upon these tests, here are the results. And she pulls out a copy. In the US, they might pull out a copy of a magazine called Men's Health and said, based upon my reading of this, here's what I think the problem is, and here's the prescription. Here's what we'll do. Probably not feeling too good at that point, not very confident in the doctor. So we go visit another doctor, get a second opinion. This time, the doctor puts you through the battery test, sits down with you, and she tells you, Ricardo, I just pulls out a copy of the Harvard Medical Journal.
Quite better,
and says, based upon my reading of your tests and the literature, there's a 70% chance the problem is this, and the recommended best treatment is X. And if that doesn't work, then we will try this treatment, and she goes on to explain the pros and cons. Now you feel a lot better because you're looking at peer-reviewed academic evidence. And so that's what I write about. Everything in my books talks about peer-reviewed evidence. So the equivalent of the New England Journal of Medicine or the Harvard Medical Review is the Journal of Finance, Journal of Portfolio Management, etc. So my books have often 100, footnotes citing the academic literature. So hopefully that gives you the confidence that what is being prescribed is in your best interest.
Totally. Before diving deep into some more specific topics, what principles should any retail investor stick with to build a compelling long-term strategy?
Okay, that's really a great question. And I think my advice and everything I believe in is that you have three core or first principles of investing that should always be followed. The first is your decisions should always be made based upon evidence, not opinions. You get an opinion from somebody, it's worthless, right? It may even be worse than worthless because most human beings are subject to confirmation bias. So if their opinion happens to agree with your preconceived notion, you're more likely to believe it, even though it may or may not be true. And if you disagrees, you're likely to say that person doesn't know what they're talking about, and you'll ignore it. That's just human nature. We know that's true from the field of psychology. Second principle is derived from the first. And that principle is all of the evidence, it's overwhelming, not a majority, but overwhelming suggests that active management, meaning individual security selection and or market timing, is a game that it's possible to win, but the odds of doing so are so poor, it's not prudent to try. And when I wrote my first book in 1998, came out about the same time as Charles Ellis's book called Winning the Loser.
Another remarkable book.
He said it's a loser's game because 80% of the people who play lose. It's not that the people playing are losers. The game's a loser, meaning only 20% of active managers were outperforming on a risk-adjusted basis in any statistical significance. But that was before taxes. Since taxes, at least in the U.S., for taxable investors, is the largest expense, maybe it was 10%. I don't know about you, but I don't like odds of 90% against you.
No, definitely.
And about 12 years later, 13 years later, Ken French and Gene Fama wrote a paper following up on that. And by that time, the market had become much more efficient. And they found that only 2% have active managers. So you got odds of almost 50 to 1 against you. So what your second principle should be is to assume that while the market isn't perfectly efficient, it's efficient enough that you should abandon the game of active management and you should invest either in index funds, which most people think of as passive vehicles, or in funds that are what I use the term because I think passive is an awful word. It's not descriptive. I'll explain why. But the term I use is systematic, meaning no human intervention, no opinions. It's transparent, so you know exactly what the prescription is. And it's replicable, so if the fund manager leaves, the next person can come in because it's all quantitative decision. So let me explain a good example of what I mean. Most people think that the only passive funds are index funds, okay? First of all, outside of a total market fund, or maybe a Russell 3000 fund, which is close to the total market, every index fund is active. Because they're active in their decision of how to define the universe. So if you ask most people, who use the word passive, is the S&P 600 index of small cap stock, is it passive? I won't argue that, but that's wrong because there's a committee that actively chooses, in some maybe systematic way, which of the 600 stocks. Same thing is true of the S&P 500. By the way, there's a committee that chooses it, and if they stuck with the first 500 stocks, you would have gotten higher returns than if you made all the changes over the years in the roughly 75 years that it's been around. So they don't know anything either, the committee selectors. So you take a fund family like Dimensional Fund Advisors or Avantis or AQR or BlackRock that are systematic, transparent, and replicable. They may have a small cap fund that, I'll make this up just to give an example, It may buy the bottom 5% of all stocks. It may screen out and say that stocks have to trade above $2 because the evidence says penny stocks have awful performance. So they screen it out based on the evidence. They don't say, we'll buy this penny stock, but not that one. They may screen out stocks in bankruptcy because even though there may be in an index, 99% of them never pay a penny out. So they follow a rule that's systematic, transparent. So I define them as in that passive world. But many people consider fund families like Dimensional Avantis to be active, even though there's no individual security stock. So you have to be very careful in listening to what people mean and get to their definition. Anything to me that's systematic, transparent, and replicable is active only in how they define their universe based upon the peer-reviewed research. But then it's all passive. Although they may even use algorithmic trading to try to avoid forced tradings in index funds, the S&P 500 loses on average 40 or 50 basis points a year to traders, high-frequency traders, who are front-running the index itself. There's a recent paper on that. It doesn't show up in the data because it's based upon the closing prices on the last day, right? And it's not counting the hidden costs that have been front-run because the high-frequency traders like Millennium and others are buying the stocks ahead of the index, incorporating it, driving it up. Then they see this demand on the last hour because they're trying to get the last trade and buying it at the closing price. And then they'll sell it and the price goes back down after that demand goes up. So I don't own any index funds, although I would consider myself a passive investor. So number one principle, again, evidence-based, resulting in belief that markets are efficient and you should only use systematic, transparent, replicable. That leads to the next principle, which is this. If you believe that markets are efficient, which you should, then you should believe, it's the only logical conclusion, that all risk assets have the same risk-adjusted return. Not the same return. Small cap stocks are riskier. They should have higher returns, but not higher risk-adjusted return. Junk bonds are riskier than treasury bonds, so they should have higher expected but not guaranteed return. If you believe that markets are efficient and therefore all risk assets have to have the same risk-adjusted returns, which you should, because let's say people think U.S. stocks have higher expected risk-adjusted returns than emerging market stocks, then the smart people would come in and buy the emerging market stock, driving their prices up. They would use the proceeds by selling U.S. stocks till you have an equilibrium, and then all risk assets have equal risk-adjusted return, including things like illiquidity risk. One last point. If you think that all risk assets should have similar risk-adjusted returns, the only logical conclusion is you should hyper-diversify and own every risk asset that you think meets your criteria that I established in my book with Andy Birkin called Your Complete Guide to Factor Investing, which is you have to have evidence that there's a premium. That evidence has to be persistent over long periods of time. So it wasn't just a lucky outcome because you had 20 good economic years. It has to be pervasive around the globe, around asset classes. So it works in value, works in stocks and bonds, commodities and currencies, because we're trying to minimize, if not eliminate, the risk of data mining, just finding a correlation, but it could be have no real causation behind it. Should be robust to various definitions. So value works whether you look at PE, EBITDA to enterprise value, price to book. And momentum works whether using short-term, long-term, intermediate signals, or a combination of them. It has to be implementable. Doesn't do any good if there's a 3% small cap premium, but it costs you 4% to trade it. And there has to be logical reasons, either risk or behavioral based, for why that premium you think should persist. If it doesn't meet all of them, don't invest. So I invest in more like a risk parity type of strategy, trying to have an equal amount of risk in many different asset classes. So not just stocks, but small in value and real estate and reinsurance and private credit and lots of asset classes, long, short, factor strategy, because I think they all have similar risk-adjusted returns, and I can't forecast, nor can anybody else, which will do well when. So that should be your core principles, those things.
Amazing. Thank you so much. With that being said, let's simplify a little bit and just talk about stocks. As far as we know now, assuming the market is pretty efficient in pricing securities, all stocks have the same risk-adjusted return. I think this is one of the most misunderstood concepts when one starts investing. And I think the reason is why people fail to understand what drives stock market returns. Could you please expand on that?
Yeah. So the most important lesson I generally can teach people is to not make the mistake of confusing information with what I call value-added information. Best company in the world today, maybe some people would say, might be NVIDIA. Let's take, Ford Motor as another alternative. So why do people think that you could make money betting on NVIDIA when everyone knows it's a better company, the growth prospects are better, it's got stronger finance, better balance sheet, better management, everything else than Ford Motor does? The problem is they don't understand. Let's say I asked you, you wanted to invest, you tell me NVIDIA, and then I ask you why. Give me the reasons why you want to invest. And you go through a list of 20 great reasons. I'm going to agree with all of them, and I say it's meaningless because the question you haven't answered is this: Ricardo, are you the only one who knows those things? And the answer clearly is not. Warren Buffett knows it. The people at J.P. Morgan and Morgan Stanley and Renaissance Technology, they certainly know it. And their people are world-class mathematicians, PhDs in finance with the best computer databases. They get to interview these companies all of the time. They're spending 100% of their time on this. Why do you think you are going to be able to outguess them? In other words, if NVIDIA, I'll make this up, was trading at 100 and Ford Motor was trading at 10, if they thought NVIDIA was a better buy, it wouldn't be trading at 100. They would sell Ford at 10, take the cash, buy NVIDIA and drive it up until maybe its price was 120 and Ford was 8. And now an equal amount of risk and return would be there, and no one would really have an interest in trading. The best estimate of the right price of a stock is its current price. And we know that because the evidence is the vast majority of people who try to outperform fail. I'll give you one little last story. The evidence on all of the studies done on individual investors shows that the stocks they buy go on to underperform after they buy, and the stocks they sell go on to outperform after they sell. Now, you have to ask, who's on the other side? Somebody's making it. It's the big institutions. The problem is there aren't enough of us retail investors around to cover their extra costs and fees they're charging your local Italian investors. So, today only about 10% of trading is done by the retail investor. 90%. So that means when J.P. Morgan is buying, say, NVIDIA because they think it's undervalued, Morgan Stanley is selling it, and only one of them can be right. And they both are incurring expenses. So that's the key to understand. is whatever reason you think of you buying a stock, you have to ask, are you the only one who knows it? The obvious answer is you're not. All of the big institutions know it, and that information is embedded in the price. So the only way you're likely to outperform is if the company does even better than the expectations already built into the price already.
Sure, when it comes as a surprise. The first role model that comes to mind when one starts investing is obviously the legendary Warren Buffett, and many people are prone to think that it shouldn't be that difficult to invest like he does and become a successful individual stock picker. After all, he has made very straightforward decisions along his career. He bought Apple, Exxon, Bank of America, Coca-Cola, American Express. It seems easy. One thinks it's about buying great companies and waiting for the returns to outgrow that of the S&P 500. I feel I can do the same. Of course, the reality is completely another story. What did Warren Buffett understand 50 years before anyone else that made him so successful and hardly replicable?
Exactly. Warren Buffett, it was able to exploit anomalies in the market or mispricing because the academics had not uncovered that the fact that there were certain characteristics or traits of stock that led to outperformance. Okay. Warren Buffett was telling people for decades what kind of stocks he was buying. It shouldn't have been a secret. Okay. So he said, buy stocks that are cheap but profitable. They have, strong balance sheets, low volatility of earnings. Okay. So cheap, what we would call quality companies. Finally, the academics, in effect, began to reverse engineer what Buffett was saying. And they said, look, let's see if we can identify these traits and characteristics. If we can, we could buy an index of all the stocks that meet that criteria. And let's see if we can get the same kind of returns as Buffett. If we can, then Buffett's genius was not stock picking or market timing, but in identifying before everybody else what the traits and characteristics were. Warren Buffett outperformed investors for the first 50 or 60 years. From 2008 on, so now we have 17 years, he hasn't outperformed anything anymore because the market caught up with him. And today I invest in the same types of stocks he recommends, and the funds I use only buy those types of stocks and incorporate that information and do it in a much cheaper manner than active managers. And the odds are you're going to outperform 90% or more of the active managers if you do that in the long term. So Buffett's genius was he figured this stuff out, one, before everybody else, and number two, he never panicked and sold. The only time he would sell is when everyone else was greedy. When everyone else was panic selling, he would buy because he felt that the market had gotten mispriced due to fear and panic. Yeah. So let me add one other thing. People think just buy the great growth companies, like NVIDIA, okay? The problem is those expectations are already built into the price, and that's why you have to pay, say, 50 times earnings to buy NVIDIA. So if you get $1 of earnings, you got to pay 50 to get that. And then Ford Motor, you may only have to pay 7 times earnings. And the only way NVIDIA will outperform is if they grow even faster than already expected. And here's what most people fail to understand. In this research has been out there for now 80 years and made famous by Farmer and French in their 98 paper. They found that abnormal growth in earnings, both good and bad, reverted to the mean at an incredibly high rate of 40%. Now, what that means is, let's say the typical company is growing earnings at about let's call it 6% a year. 3% GMP growth, 3% inflation, so you're growing 6% a year. Say you're NVIDIA and you're growing, just to keep the math here simple, at 26%. So your abnormal earnings are 20. 26 minus 6. The next year, on average, you will take that 20, multiply it by 0.4, and you're only going to grow 12 excess, so you're only going to grow at 18. Now, if the market's expecting you to keep growing at 26 and you only grow at 18, your stock price is going to crash. And that's exactly what happens. And the reverse is true of bad companies, and here's why. When you have excess profits, that attracts competition. And more supply comes in, and the ability to earn excess profits goes down. When you have negative profits, people leave the industry, and now the supply shrinks, and then profitability can be restored. And the market investors persistently underestimate the ability of the mean reversion. So turns out that, yes, it's true, growth companies grow their earnings faster than value companies, but value companies have outperformed for 100 years over the long term because of this reversion to the mean that the market is not fully pricing for.
We have short memories because I think it's at least for 20 years that value stocks have underperformed growth stocks. When Eugene Fama came here, he told us that after they published the paper on the three-factor model, people started piling into the value factor and the value effect began to disappear. And now we may be on to some kind of a reversal. We're in a situation where growth stocks dominate the market, but very savvy people like Cliff Asness, for example, keep telling us, don't chase the market, consider investing in quality, value, international stocks, because US large growth stocks overperformance cannot last forever. The problem is that it takes a very long time and patience to stick with this strategy. And I think this is the most difficult thing because the typical investor draws conclusions too fast and fails to understand how market cycles really play out.
Yeah, absolutely. I think one of the biggest mistakes investors make is they think when it comes to judging the performance of either a manager or an asset class, they think that 3 years is a long time, 5 years is very long, and 10 years is like infinity. Any good financial economist would tell you 10 years is likely nothing more than noise, meaning it's a random period of performance. And if you doubt that, I'll give you a few statistics to change your mind. Most people don't know this, but there are 3 periods of at least 13 years where the S&P underperformed treasury bills. The 15 years from 1929 to 43, the 17 years from 66 to 82, and more recently 2000 through 12. And there's a 40-year period when large and small growth stocks underperform 20-year treasury bonds, and that's a riskless investment for a pension plan with nominal obligations. That's 40 years.
It's
now,
a
the last
lifetime.
15 or 17 have been good, but how many people would have waited 40 years and say, I'm going to stick with it, right? So the key then is understand that all risk assets will go through long periods of underperformance. That's not a reason to avoid them. You don't avoid the S&P because of 3 periods of at least 13 years where they underperform T-bills. Because in the other half of the time, you get spectacular returns, right? But you can't earn them unless you're there. So the logic is you want to hyper diversify so you don't have all your eggs in what happens to be the wrong basket at the wrong time. And then you just simply rebalance. And when something does poorly, you rebalance and buy more of it and take some chips off the table when things have gone well. Let me add that one last point is really hit home because we've seen now from '09 through 24, where, as you noted, growth has far outperformed value. Not every year, but over the 17 or 16 years of that period. Okay? The three periods I mentioned were the S&P, which has been the best performer now for the last 16 years, where they underperformed. All were preceded by spectacular returns in the period before. The Roaring '20s, and then we had the Great Depression. We had the Nifty 50 era coming out of World War II, when stocks went through the roof in the 50s, right up to the mid 60s. And then we had the dot-com bust, and the 20 years from 83 to 99 were the best years ever, but then it blew up. So we're maybe at the end of this period, but you don't know. We had a great run from 82 through 95, but 96 through 99 was even better. That's why Cliff Asner says, don't sin, right? Just stay the course. But if you're going to sin, okay, sin a little, but, it's hard to time it because you don't know when these regimes will end. High valuations predict over the long term low returns, but they tell you literally nothing about the next year returns. Literally nothing. There's no correlation between valuations and next year's return. But there is a high correlation between today's valuations and returns of a decade or longer.
So we should expect lower future returns because we have that higher valuations now.
That's only true for the U.S., though, Ricardo. International, which has underperformed since '08, it outperformed especially emerging markets in the first decade of the century. But today they're selling at or maybe even slightly below their historical averages, while the U.S., particularly the big cap indices, are trading well above. So I would say for the U.S., you should expect below average returns or below historical returns for the large cap stocks, but not for smaller value, especially value. They're trading below historical averages. And outside the U.S., I would look for more historically average kinds of returns.
I always tell my US guests that here in Italy, we have this reverse home country bias and overweight the US stocks. Because if we simply invest in the MSCI World, which is our typical benchmark, we are exposed 72% to the S&P 500. And we don't like investing in Europe so much because we say, hey, the US is great, they have the best company in the world, its economy has become twice as big as Europe's economy in the last 15 years. So why bother investing in France, Germany, Italy, and the UK if this S&P 500 delivers an average of a 10% yearly compound return, even more in the last decade? And it's difficult to anticipate a reversion to the mean because it may take a very long time to happen while we live and think and decide always in the short term. You always say that we should expect lower future returns because in the last 40 years we have seen a steady decline in interest rates that drove valuations higher. The 10% average return of the S&P 500 has come at a cost. Higher and higher price-to-earnings ratios. In other words, we pay more now for the same earnings than in the past. What would you comment on that?
Yeah, well, I would add this, that most people forget or choose to ignore. A very significant portion of the earnings growth came from margin expansion in the U.S., so profit margin. And a huge percentage of that came from lower interest expense, which is now reversing, right? Because interest rates have gone way up, 500 basis points or so from their lows. So that's almost impossible to repeat unless rates were to collapse again. So not only do you have high valuations, but you can't get a repeat of margin expansion, at least it's unlikely.
Totally agree. The typical way to invest is a mixed portfolio of stocks and bonds, with the 60-40 being the most common benchmark. You told us before that you have a more sophisticated idea about diversification, not only consisting in stocks and bonds, because stocks embed most of the risk in the portfolio, while other approaches like risk parity spread the risk across different asset classes. Would you please explain what risk parity means?
Yeah, sure. This is a mistake that is very common, especially for individual investors. If you have a 60-40 portfolio, let's say it was $1 million, and I asked the average investor how much of your risk is in stocks, they would say 60%. Okay, because you got 600,000 in stocks and 400,000, but that's clearly wrong because stocks are much more risky than the safe bonds. A simple math example helps. Equities, one measure of risk, it's not the only one, but it's a pretty good one, is volatility. So stocks have a volatility, keep the math simple, let's call it 20. 60% times 20, that's 1,200 risk points. We think of a budget that somebody might have. What's the total risk in the portfolio? 40% is bonds. If you take a typical, say, intermediate bond, 5 years, treasury, low, no credit risk. So that might have a volatility of 4. Okay, so now you have 40% times 4. That's 160 risk points. 160 and 1,200 is 1,360. You got 90% of your risk is in stocks. That's not risk parity. Okay, so what risk parity means, and I'm a big fan of the idea directionally, but I'm not a risk parity investor. But risk parity means you put an equal amount of risk in each asset. And the only way you could do that with bonds is you have to lever it up, borrow a lot of money, and that wouldn't work because the cost of borrowing would make it inefficient, at least for individual investors. And in addition, there are certain risks that I can bear more easily than others might be. So I want to overweight the risks that I can bear. So for example, most higher net worth people don't spend more than, say, 5% of their portfolio in a year. So maybe you want to reserve if there's an emergency, so double it to 10%. So you could then invest, in theory, 90% in less liquid investments. I'm not suggesting that, but most people, if they have alternatives like reinsurance or private credit or private real estate or other things like that, they may only have 5 or 10% of their portfolio. Now, the Yales and Harvards of the world long ago, figured out that they're only spending, say, 6% or 7% of their portfolio every year. So they could load up on illiquid assets. And because investors hate illiquidity, there's a big premium. I mean, private real estate returns are, call it 3% above public real estate. Okay. Reinsurance over a reinsurance cat bond fund has much higher expected return because you're buying what's called a quota share. It's a contract for a year. You can't get out of it. Okay. And so you can invest in things that are illiquid, like private credit, because you're committing to a 7-year loan and it's not a publicly available security, so you can't get your money out. But now there are interval fund structures in the U.S. where you can get a minimum of 5% every quarter. So you can get out minimum of 20% a year. And so you can invest more. And since I don't need liquidity, 40-50% of my assets are in illiquid investments, because to me, that's almost a free lunch. I wouldn't call it exactly a free lunch, but I'm getting paid to take a risk that isn't a risk for me. I have other assets. Should I need them, I can sell those. Keep some amount in money market funds and treasury type of instruments that are liquid, and I can use that to rebalance, etc. And I take the dividends and distributions. So I'm getting 8, 10% in cash flow. So I can use that as well. So I think the average investor should own less equities than they typically own, than 60. Should own more alternatives. Now, I don't know if they're readily available to European investors as they are in the US, and fees have come way down. 10 years ago, I would not have invested in these alternatives because the fund sponsors were taking all of the benefit, charging 2 and 20% carry. So what that means is, let's say an alternative was yielding 15 versus a public at 10. Just to give it. If you're paying 2 and 20% of 15 is 3 and 2% is 5, you've given away all the value. Today, you can invest in that same vehicle for something like 1.5% and no carry. So now you're able to capture much more of that benefit. And therefore, that's why I'm investing in those things. So real estate, long, short equity funds. I invest in funds run by AQR that invest in these various factors that you can invest in as well. Life settlements is another area. Drug royalties. These are things that are somewhat uncorrelated to stock and bond risk. So their risks are unique and therefore don't always go up and down with stocks. In 2022, my portfolio, even though stocks and bonds were both lost double digits, my portfolio actually went up slightly because all the alternatives happened, luckily, to go up. You can't guarantee that, of course. But in other years, they underperformed, but that's okay. I want a smoother ride. Not all of my eggs are in one basket.
What do you think about the old-fashioned idea of investing in gold to diversify the stocks and bonds portfolio?
Yeah. Most people don't invest in gold to get a high expected return or diversify. They're usually, the main reason is as an inflation hedge. That's the typical reason. And unfortunately, gold, unless you have at least a 100-year horizon, gold is not an inflation hedge. And the best example I can give you is you cannot call yourself an inflation hedge if you lose over a 23-year period 86% of your real value. And gold from 80 through 2003 went from 850 to 270 when inflation was going up 4% a year. So you lost 86% of your money. Now, gold does provide some diversification benefits sometimes, not always, because it does hedge some geopolitical risks and it hedges some loose fiscal and monetary policy. So if you get excess money printing and inflation, then gold over the long term will rise. But I would add this. You should always keep this in mind, that just because something might be a hedge doesn't mean you should expect a good return. Would you invest in something that over 2,000 years generated no real return?
Put this way, no.
Well, that's gold. And when Jesus walked the earth, an ounce of gold bought a good Roman centurion a suit of clothes. That's about what a good Italian suit would cost today for a Wall Street investment banker, is about the 26 or 700 that an ounce of gold is today. And, maybe you could add in a nice pair of Italian shoes. Maybe. So you got no return for over 2,000 years. So personally, I think there are much better alternatives like reinsurance, like private credit that have a high expected return. But I have no objection to somebody who recognizes that they should not expect a high return, but they're looking for some hedge or diversification to protect. But you better be prepared to wait 30, 40 years, because gold's history is it goes through long periods of awful performance and then short bursts of great performance when governments screw up.
When it comes to lazy portfolios, the 60-40, the tree fund portfolio from the Bogleheads, the all-weather from Ray Dalio, and so on and so forth. among the most famous, there's a Larry Swedroe portfolio too. Would you please tell us something about it?
Yeah, somebody asked me once to create a portfolio. Now, I had to give him one.
Is that real?
No, it wasn't. It was somebody asked me to create a lazy portfolio that the average investor with only access to retail funds could buy. And so it would never have been what I recommended, but it was more towards a risk parity type of strategy. But it was not mine, but they called it the Larry Swedroe portfolio. So.
Which is something like 30% small value stocks,
Right.
And the rest in bonds and something like this.
Yeah, because the reason is over the long term, stocks got you 10% and small value got, say, 13.5. So you could own a lot less stocks because the stocks you owned had a higher expected return. And the result was that you ended up in about the same place, but your tail risk was way down because even if small value did poor in a year like 08 or 2000 or whatever, the market goes down 40, so you went down 50, but you only own 30% instead of 60%. And so your highs weren't as high, but your lows weren't as low, and therefore you didn't have that sequence risk, or your portfolio doesn't blow up and you panic and sell. So it was a more stable portfolio, one I think the average retiree in particular could be more comfortable holding. I wrote about that in my book. Those of you who are interested in this kind of idea, I wrote a book with Kevin Grogan called Reducing the Risk of Black Swans. So that's updated with more of the kind of portfolio that I would build with a Larry Swedroe type.
Great. If one can only have access to retail products because, we are here in Europe, we have the EU regulations, we have a lot of constraints. Let's say we can only invest in UCITS, ETFs, which is the typical way to invest here. Given that, would you suggest reducing the market cap weighted equity exposure and instead factor tilting the portfolio?
I would certainly suggest it, but only for people who can ignore noise. Meaning, you got to be willing to stick with it for 10 years or 20 years or forever. And now is certainly a better time than it would have been in 08 or 09, because the factors from 2000 to 8 did far outperform. The S&P was the worst performing asset class in the world, pretty much, in that period. And so value premium shrunk. The history showed the premium got bigger, but future value premiums had to go down because the spreads between value and growth stock shrunk. Now the reverse is true. I'll make this up, but just as an example, let's say the historical spread when Farmer and French wrote their famous paper between value and growth, just to say price to book was twice as much for growth. By 1999, it may have been 4 times. So growth was super expensive, and people should have expected the value premium to go way up. That's what happened over the next 8 years. And now maybe it went down to 1.5 because value went way outperformed. Now maybe it's back to 4 again. Again, I'm just making an example, okay? So the spread is way wider. It's about in the 85th or 90th percentile. So if you're ever going to tilt or sin a little, you want to do it when the odds are in your favor, meaning valuations are more favorable. It's not a guarantee, but it puts the odds in your favor, and that's all you could ever do in investing.
Yeah, definitely. Larry, last question. There is a new administration in the US. Should we care who sits in the White House when it comes to deciding how to invest?
Yeah, well, first of all, I would remind you of the first lesson we talked about today, which was about information and value added. So anything you think you know, right, or you think you can forecast better than the others, look in the mirror, and unless you see Warren Buffett, and you're not likely to. I suggest have a plan, stick with it, and stop trying to forecast. And, I wrote a book called Think, Act, and Invest Like Warren Buffett. And the irony I point out in the book, that investors idolize Buffett, and they tend to do exactly the opposite of what he tells them to do. He tells them don't pick stocks, own index funds. He tells them never try to time the market, and they do. And then he says, if you're going to time the market, buy when everyone's panic selling and buy and sell when everyone's greedy. They tend to do the reverse.
The other way around.
What did he say about forecasts? He says, I haven't listened to an economic or market forecast in 25 years because there are no good forecasts. The future is unknowable. And therefore, you should have a plan that incorporates both the good possibilities and the negative possible outcomes, and make sure your portfolio can withstand those negative And the only way I know to do that is diversification, which has been called the only free lunch in investing.
Larry, thank you so much for being here and for all the invaluable wisdom you have provided.
My pleasure. Happy to come back anytime, Ricardo.
We're waiting for you to come back soon. Bye-bye.
Bye-bye.
And that's all, folks. I hope you enjoyed this episode and that once again it helped make you more informed and thoughtful investors. The future is unpredictable, which means it's impossible to know today what the best decisions for tomorrow will be. What we can know for sure, however, is which decisions are the worst ones to make. And Larry Swedroe has shared one gem after another to help us manage our money using only objective data and sound reasoning. Thank you so much, Larry. I know for sure you'll be listening to this, and we can't wait to have you back with us in the future. And a quick reminder to all of you, you can purchase Larry's book and reach your future at the link in this episode's description. In the meantime, make sure to hit follow and turn on notifications on Spotify, Apple Podcasts, or wherever you are listening. And also please consider leaving a 5-star review to support us and help us continue bringing you amazing guests, people like Larry, who are not only incredibly knowledgeable, but also remarkably humble and generous in sharing their wisdom. Always new. But that's really all for this episode, and I'll see you next Wednesday for another deep dive into one of your favorite topics, individual bonds or bond ETFs. My definitive take. Right here, of course, on The Bull, your personal finance podcast.